All right, next up for the seventh set here is dealing with sales taxes and credit card sales. Now, again, this is by law. You have to collect taxes on all intrastate sales as opposed to interstate. Now, of course, there was a Supreme Court ruling not that long ago that ruled that you can't actually collect on interstate sales, and the state of Illinois is trying to do that. In other words, if you want to, collect sale that was on somebody made, to somebody who lives in Illinois, they're going to make the person that sold the goods to them in Illinois collect sales taxes and remit it to the state. Now, exactly how that works mechanism-wise is pretty complicated, but just let you know that it is out there, and it is a thing. Certain sites, like, for example, eBay, are arranging to collect those sales taxes on behalf of sellers, right? So if you sell to somebody in a state like that, they'll collect on your behalf, and you won't even be included in the process. So that's the good news there, because it could get a little bit complicated for small business sellers to have to collect all that stuff and then deal with all the remitting to the state and whatnot. That can get really kind of crazy. Right now, again, there is a big exception though across the board as far as collecting sales taxes, and that is if you have dealing with a sale of goods for resale. All you have to do is provide a state tax ID number, and the seller's going to waive the sales taxes. That's the good news there. So if you fit into that situation where you're somebody who's just buying goods for resale, you don't have to. They're not going to collect sales taxes on that. And as the seller of goods in that situation, you don't have to collect sales taxes. Now again, state to state, this is all over the board, but the mechanics are the same as far as like what the accounting looks like. So never mind like what went into getting the numbers necessarily in some cases. Just focus on the mechanics of like how do the transactions look. So in this case, we're going to do something for Diva Collectibles on March 10th of 2019. They sold $6,000 on account with a cost of $4,000. Again, we're doing this assuming perpetual inventory in a state with a sales tax rate of 10%. Right. So the particulars here. So the amount of the sale is going to be still $6,000. And we're going to take 10% of that $6,000, and that's going to equal the amount of the sales taxes payable. Again, we don't get to keep this, obviously. We have to remit this to the state in question that we're collecting on behalf of. So these two numbers together, when added together, equal the amount that we would debit to the accounts receivable for a customer. And of course, the cost of the sale is consistent with what you saw back in it would be the fourth chapter of this class. Cost of goods sold, debit, merchandise, inventory credit, those mean the same thing, right? As I said, so often what's going to happen is you're going to have to remit payment to the states in question that you're collecting sales taxes for. So let's say Diva remits payment for all sales taxes collected in the month of March, $6,555. So this is the entry they would have to make on that date. They would make sales taxes payable, debit, cash, credit for that amount. Now that might be a total amount collected on behalf of several states, and those payments are remitted to those several states on that same date. That tends to be the cutoff for a lot of states, is they usually ask for the funds by the 5th of the following month of collection. That's pretty common. Now, retailers who waive sales taxes as a promotion, that's usually how that goes, are still responsible for paying the appropriate amount on all intrastate sales. So you still have to collect those sales taxes as if you were collecting on the sale. The exact mechanics of that are not included in the scope of this class, just let you know that it's out there. Now, retailers that accept credit and debit cards must first secure what's called a merchant account with a bank as a conduit for running those charges. So that's all a merchant account is. It allows you to be able to, take these types of cards. Now, of course, the good news is there are a lot of, conduits to this that don't necessarily require you going through the formality of opening up a merchant account. In some cases, excuse me, you have like card readers attached to cell phones and things like that, where you set up an account with them. So in essence, that becomes your merchant account. Or if you take payment through PayPal and you have to collect, sales taxes, or I should say, you make collections there, they'll usually, like in the case of like PayPal, they usually will take whatever it costs for having the merchant account off the top. Like every time you run a transaction through there, they'll take their fees off the top. So in other words, this fee for having the merchant account, which I usually say it's around 4% nowadays, and it's usually a sliding scale. Like it gets to be less and less the more you charge through it. So the greater your volume, the smaller that they'll charge you to have this merchant account is the way it works. But again, it depends on your agreement how much you're going to get charged. So again, we're just going to assume in this example that it's a 4% flat fee, just as a simplifying factor here. All right, so let's say again, May 7th, the same company here, Diva, is going to sell $1,000 of goods on credit cards, cost of $500 to them. Again, that's just the cost of the sale. And this is going to be a situation where the funds are deposited immediately, because there's a slightly different way of tackling this. If it's not, in other words, we treat most credit card sales the same as what? As cash. That's how it's going to look. Now let's say that there's a merchant account, there's a 4% fee for running charges. So this is still assuming the same 10% sales tax rate that we did in the previous example. So in other words, the amount of the sale is $1,000. The tax on the sale is 10% of that, or $100. So we have a total of $1,100 here that's being run as a charge. Now again, the way this account works is we take the money out at the front, so it's going to be $1,100 times your 4%. So that 4% amount there is going to immediately be expensed as credit card expense. So that's where you're getting that $44 from. So in other words, how much do we get deposited directly to our cash account? It's going to be the $1,100 minus 44 equals $1,056. So that's where that 1056 comes from. And of course, the cost of the sale gets booked immediately, like you see here. Now, what if the funds are not available for 5 days until after the sale? So notice this is pretty much the same transaction as before, except here the 1056 isn't to cash, it's accounts receivable, and you might set up a temporary AR account called credit card company. In other words, it's a holding place. You know you're going to get the funds, but there's this little holding period, so you temporarily dump it in an AR, and then 5 days passes, so 5 days later we book this transaction that you're looking at right here. In other words, now we have cash, debit, accounts receivable, credit card company credit for the 1056. So that's the way you have to treat it if there is any hold at all on the funds. If there's no hold, it's the same as cash. That's the rule. All right, that concludes the video dealing with credit card sales and merchant accounts. Not much to that one, really, for the most part. So the last installment here overall is going to talk about specific methods of depreciation and how to calculate depreciation expense on fixed assets. So I'll see you there.